Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Wednesday, June 24th, 2020. This is video number 2 today. For anyone that's been with the site for a while, you know I typically don't do video in the morning. Today I started one before the market opened. Also got some updates out a little earlier. I always say this, you know, the frequency of my analysis on any one security or trade idea, whether it's a stock, an index, a commodity, will be commensurate with the, any technical significance there. So sometimes you have very little changes in the technical posture, the market's in a trading range, or a stock or security, and then things start to come together, and you get a breakout. Things move fast. So that's why I do these videos, and what I often say is don't fall asleep at the wheel when you get that kind of slow, steady grind. If you are looking, again, if your goal is to get in short, take advantage of these rips. This is swing trading. This is investing. Is put your money in the S&P 500 index fund and start drawing out before or when you retire. But swing trading is capturing these moves, and they happen pretty quick. So I just wanted to reiterate, I did get a static post out. I know a lot of you over the years, I've had a lot of feedback that it helps to have some charts, static chart images, a couple little words, paragraph or two on what's going on. So I did get that out, but I wanted to follow up and just say it's been a while since we've had some decent sell signals, and there's a little work to be done. I'm going to go over that. That's why I wanted to do the video here, but this is it. This is a sell signal right here on QQQ. It's about as good as it gets. We had, remember, a previous high there, a couple reactions, finally a breakout. So this, and we're looking at a 60-minute chart, by the way. This right here was the breakout, and now it has proved to be a failed breakout, false breakout, bear trap, whipsaw, whatever you want to call it. Many names, all the same thing. It means you break out to new highs. Everybody thinks Qs are unstoppable. It stops, get hit on short, those that are short, and longs will take the breakout because on face value, a breakout to new all-time high on any security is bullish, because at that point in time, everybody in the security, anyone who owns QQQ or XYZ stock for that matter, on a breakout to new all-time highs, everybody's profitable, nobody's underwater, and so you don't have any trapped remorseful longs waiting to get out. However, when this happens again, those that bought there start to quickly see it goes underwater, and again, it's more of a technical thing, if nothing else. Traders are watching these trend lines just like they were watching this one here and the ones before when they break, and you get these drops, and they're pretty quick. So what I wanted to talk about is the bigger picture, and you go back in time and you say, okay, Randy, yep, it's an uptrend. It's going to be a buy the dip scenario, and it very well may be. But I do these videos because I continue to try to impress the fact one of these seemingly innocuous little 60-minute wedge breakdowns may be the one that sticks. Just like I talked about that back here in February. We had the same pattern, divergent high. You can hardly see it here because of the scaling on this chart. It was such a big move. And then finally, this little seemingly innocuous divergent high back in February was the one that did the trick, with the divergences playing out for a much bigger correction. So that's it. And remember, the most recent divergent high is simply a series of these longer building divergent highs that have been going on, with the index here, QQQ, making higher highs, and the indicators down below, RSI and PPO, making lower highs. So the takeaway is there could be the potential, as I said on the that last post, for a drop, I think, of at least from where it was when I did it, 7.5%. Let's see, wherever we were at the time, I think that would take us down here, to 225.85, and maybe 12% right here, down to about that would be actually 7.5 from where we were, 12% down to this number, and maybe even more. But we'll see. We'll take it one day at a time, one tick at a time. Don't forget the bigger picture. We have these big divergences on the weekly chart right now, negative divergence. And remember, as I pointed out, on the NASDAQ 100, we did not have negative divergence at the February highs, and we do now on the weekly time frame, that is, just on the histogram there, but not on the PPO itself or the RSI. At least we had flatline divergence there. Okay, so that's that. I wanted to just kind of set the the expectation that it may be just a little pullback trade, and if you are bullish and think this uptrend will continue, the same targets that I have here for short pullback trades could be used as objective long entries to go in for the next long with a stop somewhat below. One thing to consider is when you have a correction. Remember, stocks tend to fall a lot faster than they rise. That's one reason I'm a flexible trader. I love shorting just as much as I love going long. And but when you short, a couple things. You need to be quick to the party because usually when the reversal comes, it's pretty fast, especially during an uptrend when you're shorting counter trend moves, and sometimes even in a big primary or larger trend, like remember the March lows there. But the other thing is, since the moves on the downside are usually more impulsive in corrections, you tend to have momentum, what I call momentum fueled overshoots. In other words, if 240.56 is going to end up producing a reaction, and then there's another level here, maybe at 233.66. If you have a lot of downward velocity heading into that support level, you may overshoot it for a brief period and then snap back and probably close that 60-minute candle back on or above there. So I say that because regarding stops, if you are, let's say, again, you want to buy the first dip, you think any dip will be bought up aggressively, so you want to buy actually there's some support right there as well. That's some, and there's certainly, that's a gap. That's the bottom of that box I have for that gap. You want to buy that. You got to give it a little bit of room below. If you buy, a support, let's say 240.56, you go long there. First of all, if I did think we were going to do this, then I wouldn't wait for 240.56. I'd buy at 240.65 maybe, a little bit above in case all the buyers or most of the buyers step in early. And the other thing is, if I did buy there, I wouldn't have my stop at 240.55. I'd have it comfortably below to allow that little momentum fueled overshoot. But as of now, I think there's certainly the potential for more downside. Despite the resiliency of the uptrend and the fact that we have now sell signals on the tech-heavy Qs. Remember, that's one thing that's been lacking. That's where most of the money's been moving into lately. And on NQ, did this in the video earlier today, so I'll be quick here. This was that recent breakout right there. We had previous high, reaction high there, previous reaction high there, breakout, and now that's proved to be a false breakout, aka bear trap. And you can see the impulsive nature of it. We didn't just limp on down. Once that level, that's the level I was highlighting in the video earlier today. 10-10-107 needs to go, and there's your sell signal, and there's a drop in relatively short order of about I can't start right on the line, or it drags it and moves the line away about 2%. And so the takeaways is if you are, it's one thing to go long in an uptrend. You can get bailed out if you go in the wrong time. If you're going to keep grinding up, but if you're going to short, you need to be quick. You need to have these levels on your radar and be ready to pull the trigger. Is it objective now? Well, technically speaking, depends on your time frame. Swing trade, yeah, because I think today's sell signal will have some staying power. In other words, we'll see some more downside. But as far as timing, I like to use these 60-minute charts for timing. And here's support right there, about 99.17. Decent, not super solid support because it's been chopped through several times. And we're also down, 2.5% right now. So not the best, most objective time to short. That was objective. Should we kick back to 99, 97? That might be an objective short. If we happen to rally back to 10-107, that would be objective, although I'd be a little bit suspicious because number one, the fangs didn't break down yet, and two, the way that corrections work is they tend to trap longs. They tend to trap the bulls and deny what I like to call the wannabe shorts. Those that want to be short, but they're a little gun shy, afraid to pull the trigger because the uptrend's been strong lately and a lot of dips have been getting bought up, and we've had a lot of whipsaw signals. And so where I'm going with that is when you get these signals, you tend to see this, and I like that better. The more the impulsive the drop is, the more it leaves out those. So what happens? Then you get a kickback rally, and now it lets the longs get out. shorts get in, and then you get another big drop. So I'd prefer at this point not to see a snap back up there. And I'm going to get to the fangs here in a second, and we need to see those go. Of course, the SPY is still worth watching, and that's worth mentioning. It's been lagging behind, as I showed you recently. QQQ took out the previous high, and the S&P 500, meaning really the stock market, wasn't doing it. So it is that was a clear indication that just a handful of those mega tech stocks, the FANGs, were doing most of the heavy lifting there. And so since my last update, QQQ has now broken down below the very recent trading range right here. This trading range broke down here pretty impulsively. Still needs to take out that previous low. I like to use this board right here. That's the board that I've had on it right there. So there it is. We took out the bottom of the trading range there, about 307. That's a sell signal or breakdown in SPY. So bottom line is I'm seeing more and more check marks today throughout the day. Well, check mark here for the bearish case, for the case to make the case that this was a major sell signal here. We're looking at a 60-minute chart, but it was also it could be viewed on the daily. The breakdown we had, the island top right there. There's your island cluster top, that sell signal. And this wasn't an ideal scenario, the sideways consolidation. But again, all that really matters is who wins, bulls or bears. Right now, it's an early start. In fact, the ball's in the bears' courts. And the onus is on the bulls to pull out a stick save. What's a stick save? Well, when a candlestick, particularly daily, it just means by the end of the day, if you get a candle closes back up here, that candlestick will get us back above that range, especially something like this. Even a rally back into that trading range will be, you'd have to give that to the bulls if they can recover this. Okay, so anyway, we'll see how today ends. That's what the bulls need to do, get it back in the range, and then, of course, pop above. Bears need to hold this. Any kickback now, I can tell you, as far as objective entries, if you either took a starter position, you already came into the day short, it would be a kickback to about 307 right there would be an objective entry if we get it. And if we don't get it, all the better. That'd be even more bearish, not to, just to kind of trap more longs in that start feeling pain, and then you get that real impulsive selling. So not to get excited yet, but remember, it all comes on the heel of this larger divergent high. So a correction has been priced in, a considerable correction, trend change priced in the charts, and we haven't really gotten it yet. We had a sell signal that kind of went on standby afterwards. That's the best way for me to explain it. The other thing, let's look at the FANGs real quick, and then crude oil. And then we'll wrap it up, because as I said, I've been saying for a while, crude's been setting up real nice with that bearish chart pattern. Gave us some solid sell signals today, and I said it would most certainly help short on crude if the market drops, and that's been the case today. I'll get to that in a second. We'll just go through the FANGs real quick. We can look at 60-minute charts, but let's just do that. This is a 60-minute chart. Let's go to the daily time frame. This is probably daily time frame is always more significant if you can get a sell signal on the daily, a solid breakdown, especially at close. So here's the trend line I'm watching on Apple. It's really a price channel. Apple's been diverging up, but that's it. So Apple is still comfortably above its trend line, and this is what I was trying to say earlier today in that post. That look, we have sell signals finally, a pretty decent one on the Nasdaq 100, the index itself, the tech-heavy Nasdaq 100. Yet these stocks they did so much of the heavy lifting lately that they're well above their trend lines. But this, I promise you, if the market kind of collapses from its own weight, with all that breadth deterioration that I've spoke about lately, not just in the past few days or weeks here. Remember, we had it leading up to the big drop that we had a few weeks ago. Internals deteriorating, and what tends to happen is that's showing you the economy, the stock market isn't doing as well as just a handful of stocks that happen to lift this index higher. And where I'm going with that is, if you start to see pretty impulsive selling, they will get dragged down with it. They will break due to forced selling, because they are top components of the S&P 500, top components of the Nasdaq 100. So when money flows out of those mutual funds and ETFs that track those indexes, they have to sell. and they have to sell what they hold. And not only do they have to sell what they hold, they have to sell what they hold proportionately. They're chock full of these. These are the top weighted stocks, so in other words, they have to sell more Apple than they have to sell Starbucks, for example, which is down the line a little ways as far as weighting goes. All right, so that's Apple. There's your trend line. No sell signals yet. Again, when I look at the daily chart, as much as we're down today, 2% in Apple and more than that in QQQ. I don't see anything remotely close to a decent sell signal. Just a down day. You need to take out that trend line. Maybe do something with these candles here, but I don't really see any type of bearish candlestick reversal. There was a potential little candle up there, but we didn't even gap down below it, so let's not spend any more time on that. But that's a level to watch. And then if that yellow line, that uptrend line goes, this is a big level here, even bigger, 327. And so if you're looking for levels to buy Apple, you're a bull. Well, the trend line, that's first support. Second is here, and that's a pretty big one. You had that previous divergent high that came before the big drop into the March lows. We tested it here, and finally there's your breakout candle right there, and Apple's been moving up pretty impulsively since. So those would be for a short seller, targets, and for a long looking to buy the dips, levels. And then if that goes with conviction, that would be quite bearish in my opinion, and most likely open the door for maybe a next leg down that takes out the March lows. Microsoft, divergent high, but well above trend. Here's a yellow trend line. I have two price support levels. Call that about 187. Let's just round that number off. It's so close. 187 and then 180. That's a big level. We had some consolidation around there, but that's what needs to go. All these levels here. I'll probably color that one up. Just make them all yellow. They're all very important levels. So here's the thing, for the bullish case, I'll do both sides. Glass half full. The market's going a lot higher in 2020 and beyond. This would be a healthy pullback to come and test that trend line, test the 187 level. It was around that previous high. There were a lot of reactions there. And so again, dip buyers want to see that, and short sellers or bears want to see that go, and then 180 to open the door to much more selling. But as of now, a little bit of a sell signal. There's a doji followed by a big red candle. I'm sure there's some name for that pattern. There's things you can look it up, various resources online. Amazon trend line right there. There's your uptrend line, minor uptrend line, and then a more significant yellow trend line. And to me, the big level is still 2470, and Amazon's comfortably above that. If you recall earlier today, I was in the post on the homepage, and in this video I said I was looking for a drop of at least 7.5% and possibly 12% on the Qs. Well, that would mesh with Amazon breaking down here and falling to this trend line about 7% below, and then if that trend line goes down here, that's about 10% below. And so the numbers kind of mesh right now. We just need a little more nudge. You can see if we get a solid close below this minor uptrend line on Amazon, that should help. And we have Alphabet as well. I added a trend line today. I'm going to color it up yellow. It's this one right here. This was not on my previous charts. I did have previously a 1398 is a pretty big support shelf that needs to go for Alphabet. And this is Class A shares, GOOGL. But you had the divergence has been building till recently. So this divergent high right here, we inched higher right there. So that's our divergent high right there. Need to take out that trend line, and then you can see there's a price support there about 1398, not too far below. That's what needs to happen. Otherwise, like I said, these fangs from a technical perspective, other than the divergences, which are not sell signals, I can't make a screaming case to be aggressively short just yet. Now, if things can happen fast. That's why I do these videos. By the time it happens and I start to mark up charts and try to get them out to you, or do a video, what you can see in a market that's full of a lot of hot air. And again, I'll say what I've been saying for months. Short of maybe the dot-com bubble back in the late 90s, I have never seen, and most people have done this even longer than me, so they've never seen such a disconnect between the fundamentals of the economy and what the stock market is doing. And because of that, don't underestimate how fast and hard things could drop, and just how quick the headlines will change. You might say that's crazy to see something like this, and I'm not saying that's going to happen. I am saying it could happen and be ready for it. Move fast. If you're long, you don't want to sit through that. And if you don't see any way that could possibly happen, because everything's been getting better and better, and COVID and the economy and unemployment and all that, like I said, the news flow will change on a dime when and if the market starts to fall. The news will often follow what the charts are already pricing in, or what the market's doing, and they will retrofit the headlines to say why the Dow went down. If the Dow goes up 500 points today, they'll find a reason for it, even if there is no true reason, if it was technically induced. And if the Dow drops 500 points, they're going to slap some. That's what the financial media does. That's their job. It's so, hey, why was there a 500-point drop? Sometimes there was a clear fundamental catalyst. They rarely, if ever, talk about technicals. What they'll talk about is something coming out of Washington or some economic report, and sometimes that is a catalyst as well. I'm not saying that it's never. I just am saying many times I've seen it's the technicals, and they'll just slap a reason, and then all of a sudden the market keeps going down, and all of a sudden the headlines start getting bearish. Okay, so that's that. There's the levels to watch. Let's not beat a dead horse here. Divergent high. There's the other share class of Alphabet. Again, just a lot of what stands out to me is just a lot of support, a lot of recent sideways trading. And so that's what needs to be taken out. If we can take out that's why that line's there at 1393. Boom, I think it'll be a swift ride down to probably right about here. That's 1290-ish level right there, with a little hiccup along the way at about 1330. So that's what we need to see before we get any real correction in the market. The market will only go so far with these fangs holding up. It's not just because everybody loves them. It's math. It's simple math because of their heavy weighting in the NASDAQ 100 and in the S&P 500. Facebook cracking right now below this trend line, following this we had a divergent high here. And it just extended the divergence lines right there, and big level coming up at 2278. So these are the levels to watch. Again, this is where bull looking to buy a dip would step in there. I wouldn't, because of this. And in other instances I might, but overbought at with clear negative divergences in the way the weekly charts look, and knowing the macro picture, even though sure things have gotten better in the last couple months as the economy's come back online and a lot of lockdowns were lifted, but it's far from where it was back here in February. The economy is way below there, all the economic indicators, and it just doesn't justify a lot of these companies being anywhere close to and especially above that level. That's the way I look at it from a fundamental perspective. And that's about it for the market. So those are levels to watch, developments to watch for. Crude oil, boom, 37.62 target hit. I mean, this is where, to me, the easy money is made right now. Why? Well, you had the sell signal here. I went over this morning. Numerous opportunities. Yeah, they came late in the evening, but the sell signal itself was that was yesterday. What is that? Is that 2 p.m. And then so plenty of opportunity late in the day and in the evening in the overnight session if you're trading in California or overseas or anywhere. And then boom, first target hit. You could have recycled in. I was posted today, had us bouncing to that level in that scenario I posted earlier. It was about exactly where we turned down. So you could have recycled in, added to a position, got back into one, or if you missed the whole thing, shorted there, and in just a couple hours you would have made 7% or so. On one contract of crude futures, that's putting thousands of dollars in your pocket. So again, that's why I call it the easy money, and it trades well to the technicals. You would have covered on 37.62, reverse that trade, or book profits, sidestep this little give back so far, because a reaction there on the initial tag, just like there, is likely. That's why I put those arrow breaks. And so it's simple stuff. Now, hard to say where this bounce will go. It depends. If the stock market really starts selling off today and doesn't recoup, have a snapback, recover, rally, crude will probably either come back down here, maybe pin on this number today, or break down. If the market can rally and snap back and get maybe a little more upside, but I wouldn't bank on it. What I'd bank on is watching for the next break of today's lows, that 37.62 level, opening the door for a move down to that final near-term target of about 35 on CL, and that'd be a pretty nice trade. All right, this has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.